Well, it's first, it's what we call an evergreen fund. So evergreen is opposed to the closed-ended structure. So you have the ability to decide when you want to enter the fund. You are investing into an existing portfolio of private assets, and then you decide when you want to exit. So of course, there is no magic. It's not fully liquid. You have a gate mechanism which protects the investors in case everybody wants to exit at the same time. What we can promise is 5% liquidity every quarter, and so which is about 20% per annum. And the second important thing in the thesis, investment thesis, is secondary. Our evergreen fund is investing mainly into secondary transaction, which help to have almost no J-curve into the fund, no J-curve, high diversification, and a very mature portfolio of very well-known GPs. So evergreen structure, I would say, are first new to the market. It's something which is now developing a lot. There are lots of funds which have been launched this year, and it is completely different from what you usually have in private equity, which are closed-ended structure. And this is linked, in fact, to the creation of the private equity market where initially it was mainly institutional investors investing into the asset class. And for institutional investors, they were quite used to work with closed-ended funds because they had the resources to manage their capital call, their distribution, their tax issues, their reporting. When it comes to private individuals, it's much more complex. And so we thought that having this kind of evergreen structure where investors decide when they want to enter, when they want to exit, and it's compound. So in fact, they don't have to think about reinvesting the money that we distribute. It's much more flexible than any other structure, especially for the private individuals, but also for smaller institutions looking to get a bit of flexibility in their private equity allocation. So in fact, the good thing with the Carmignac approach is that because they were new in the business, they were not conflicted with any other type of client. So it is the same philosophy of any Carmignac structure, I would say. They give the best of what they have to the end client. And so to build this business, they had strong conviction, like for any other asset classes. So I've already mentioned evergreen and secondary. But also, we thought it was important to rely on the Carmignac ecosystem, because Carmignac is a large company. They are managing already more than 35 billion of assets, and they have more than 300 people working at Carmignac. And so to rely on an ecosystem where it's not only the support function, but also the sectorial analyst, the ESG team, the macro strategist, they are all contributing, in fact, to the strategy of our fund. So in fact, we try to keep the DNA of what has been the success of Carmignac in other asset classes to produce a new type of fund together with Klipway to get access to the private equity market. That's a good question, in fact. We have to cope with the regulatory environment that we have. And so the first fund that we've launched is a Luxembourg fund, which is a UCITS Part 2, which is only for professional investors, which is a bit of an issue because, of course, you can't have pure retail. You can't communicate on the fund actively. And you have to onboard only professional investors with a minimum investment ticket of 10,000 euros. So with this in mind, I mean, we are offering a product which is very well diversified, like for institutional investors, and you can offer it to a certain type of investors. So maybe the second step for us will be at some point to come back with something more retail-oriented, which is feasible. You have new type of fund coming in at the moment, like the LTIF 2.0. And these type of funds will be more restricted in terms of investment because the European regulation asks you to invest only into European funds managed by European investors. But we may also consider this issue to try to also penetrate the retail market with something very similar. So our strategy is really to invest into very established fund with very well-known manager on high-quality assets. In fact, in secondary, you have lots of opportunities, but we think that it's better to put the right price on the right assets instead of having a very big discount on bad assets, which will never give your money back. So in fact, our goal is really to concentrate mainly on buyout strategies, portfolios of very established funds into very mature companies where you can expect to have quick money back instead of waiting many years before having the first return on your portfolios. Okay, well, first, I think it's important to keep in mind that private equity is long-term investments. And if you look at the performance of private equity over 5 years, 15 years, 10 years, 20 years, it has always overperformed the listed market and whatever the cycles, in fact. So I think it's very resilient because there is real value creation made by the different investment managers. So you need to rely on the ability of people to create value on portfolio companies over the long term. So what we do through secondary is even more interesting because it's highly diversified. When you invest into a fund, you have a limited number of companies, which is probably 20 to 30 companies. In our approach, through the secondary market, you are able to have much more underlying companies. And so today, in the portfolios that we have assembled, we already have more than 400 companies. And so with these companies, this diversification, you take less risk for sure. And so I think that's the first element. When you have uncertainties, having a very diversified portfolio will reduce your risk. And then I really think that private equity creates value over the long term. So if you are a believer into private equity, you should not worry that much about the cycles. And then last but not least, you're right. I think having the ability to invest across the world is something even more important. It's difficult to bet on the US or on Europe, especially in the current environment. In every market, you will have some winners and you will have some losers. And some company will benefit from the new tax that Trump is putting on some foreign countries, and other companies will suffer from it. So I think it's important to be very well diversified and to rely on your manager to create value over the long term.